Hello again, everyone. Thank you for attending this real estate presentation. My name is Seewing Yi from the Yi Real Estate Network, and my co-host is, once again, is Maureen McCann from Spartan Invest. As you can see, our contact information is on your screen. And today's topic is how to pay zero taxes in your real estate portfolio. What that means is how to totally eliminate or substantially eliminate your taxes regardless of how much money you earn on your regular W-2 income or working income. Does that make sense?
Yes.
Okay, before we go any further, let me share. Maureen and I would like to share you our disclaimer. This presentation is for information purposes only. It's general knowledge. We are educating our people out there. We are not a licensed tax advisor. So our disclaimer is you must consult your own tax advisor and your own financial advisor to go over your unique situation based on your goals and financial goals and objectives and your risk tolerance, because real estate investing, just like any other asset class, there's a potential for loss of principal and what have you. So with that said, shall we continue?
We shall. Let's go.
Before we will dive into the topic, we have to take a step back and just to reiterate the importance of this high level concept. Okay.
Yes.
Which is, if you want to become a serious real estate investor, when you're venturing into this space, if you will, if you buy one or more rental property on a historical basis, based on long-term past 100-year of track record, maybe even more, I don't know. Income property is history's most powerful and proven and most attractive and most tax-favored multi-dimensional real estate asset class in history. So because you're getting cash flow, income, passive income, that is, depreciation tax benefit, which we can talk about in today's video, and you get long-term appreciation over time, and then you get the power of leverage using debt, using financing, using a 30-year fixed rate mortgage, which is a hedge against inflation, to leverage your real estate investment purchases. All right. Any other questions for you, Maureen, before we begin?
No, you got that drilled in my head, you know. I think it's finally there, Seewing. You got it stuck in there.
We got a lot more people's head to be drilled.
Well, because we know the benefit. We know the benefits. Personally, we've learned ourselves, and I've built an entire business off of helping investors understand what the multi-dimensional way of earning through owning a hard asset like real estate does. And that's why we're so passionate about getting the message out there. But I love it because the ideal investment, I've got it in my mind, it's in my brain. The ideal investment is a hard asset that pays you in multiple ways. I got it.
Absolutely, absolutely, and that's right. That's that's history of real estate, right? If you do not learn your history, you're doomed to repeat it. Did I say it right?
Yeah, no, I mean, think about it from somebody that has actually invested in real estate. They know what we're talking about. And for those investors that have not invested in real estate, they don't know what we're talking about. And in times where I like what Dave Childers said the other day, I like this. He said, may I for just a second?
Sure.
Okay. So Dave Childers from the Keeping Current Matters, great video blog. If you guys aren't tuning in, you should tune into him. Phenomenal content, great infographics. If you're a visual learner and you want the graphs to show you what is happening in the, as far as the home builders, what they're doing, the number of contracts that are out there, the the historic interest rates. He's phenomenal. So guys, tune in to Keeping Current Matters. But I loved what he said. He said he gave some things that were changing, right? We're in a shifting market. And, he talked about from January to today, the average 30-year fixed went from 3.22% to 5.5%. The home builder cancellation rate nationally from June of 2022 was 14.5% of residential contracts were canceled. That's just fear. Those are the fear. Or if they're in a situation of job loss, like there's things that are legit, but some of that is fear driven. Okay. So they're preying on the fear. April, so that was June of 2022, April of 2020, right? We all know what happened in 2020. April 2020, the beginning of the pandemic, 16% of contracts canceled. So we're still below, but creeping up, right? And he's like, the question was, what does this tell us? That's the big question mark, right? There's a tremendous amount of change that is leading to a lot of fear in the market, but there is opportunity in every market. You just have to be able to cut through it with facts, not fiction, to make an educated and informed decision. So here's the part that I wanted to get to, and here's what he said, because that was the setup, right? He said, if fear is left unchecked, it leads to uncertainty in the market. In times of uncertainty, people follow the certainty. And if that is not unchecked, it will ultimately lead to paralysis. Think about that. Check your fear. If you leave it unchecked and you believe you just catch a subject line or something scrolling through social media and it's fear-based crisis and chaos and headwinds and, all these terms that really kind of get you feeling scared and then hesitant, and then something happens, and then just all of the things that that work or have worked for you in the past, all of a sudden that's like, it's like a blank slate. You're like, I don't know what to do with my capital. Where do I go? Right? It's paralysis. And Seewing and I are dedicated to fighting that paralysis and helping you cut through with facts, figures, numbers, data. That's why I like David Childers at Keeping Current Matters. It's all factual. It's all data. And so the last thing you said is, in times of uncertainty, people follow the certainty. And if it is not unchecked, it will ultimately lead to paralysis. Therefore, they don't do anything. They're uncertain about the future. They're not sure. We're scared. We don't know what to do. We're going to take the wait and see approach. And Seewing and I have showed you in videos even prior to this one, the wait and see approach is costing you, not just in the higher cost of borrowing, right? We know that that's here, probably going to exist for the next quarter, maybe two, right? But you're missing out. Your capital is missing out on that depreciation benefit, the appreciation benefit, the rent escalation benefit, and if you levered into the deal, the amortization or the loan pay down benefit. So with that said, I'm turning it back over to you, but it was it was just a great little point that I wanted to talk about the uncertainty. And if you leave it unchecked, it leads to fear and paralysis. We're not paralyzed here.
Maureen, very well said. I have heard this same message in a different way over the years, as a matter of fact. That's what's happening in the current environment, right? So much negative headlines, so much negative information putting out there by those YouTubers and all those clickbait YouTubers out there. They're everywhere. Crash, correction this, 50%, of the numeric 50%, or the 40%, 80%. You might as well put down 100% loss of a house value. I mean, while you at it, those YouTubers and the news media, the social media, the mass media, they all play a part of it. So over the years, we're seeing this with our own investors as well, right? So many of our members are sitting on the sideline for this very reason we just discussed. Not just right now, over the years, you and I, we know human interactions. We know human emotions, right? And because not surprising what's going on right now, because over the years, our challenge and frustration, we try to consult with investors and try to give them the best advice, but at the end of the day, it's all about fear. And so it's sad. So that's the way it is. That's human beings, and you and I, the best we can do is, with the limited time that we have, we try to find we try to educate and inform people and find a small percentage of people that are willing to overcome this false narrative and take action, right?
Yeah, and they're out there. I mean, we've had several sales here this past week, and it's like the people that are fearful, they're going to stay on the sideline, and the ones that see the opportunity, they're jumping in and they're not slowing down. And it's so encouraging to see that. But I'm like, there should be so many more that are, because this is an opportunity to get into something, especially where inflation goes, wherever this inflation thing needle ends, you know what I mean? In the interim, what do you do to protect your family? What do you do to protect your financial future? What do you do to protect your, your retirement? I mean, think about people that are in there, I don't know, getting ready, they're on the cusp of retiring. This inflationary thing right now, it's going to push them out working longer. So do they want to work are they going to commit to their mind, go, well, I'll just work another 20 years, or do you get your money to work harder for you and a hard asset that pays you in multiple ways? And that's what we're talking about here today.
Exactly. It's an uphill struggle, and we just...
We're going to keep trying, Seewing. We're going to keep trying.
That's all we can do. That's all we can do. All right. All right. Back to our regularly scheduled program.
I derailed us. Sorry.
It's okay. It's all good. It's powerful. I mean, you and I, we think spontaneously. We just something trigger our brain, something we need to discuss. Very timing. We just did that. I mean, it's just important things that came out of your mouth. So
thank you. Hopefully it sticks and it lands. All right. So back to the regularly scheduled program.
Yes. Okay, how to pay zero taxes. Okay, here we go. All right, now not requires a unique understanding for a particular risk investor to apply some of these strategies. Not everyone can do it, but at the same time, I still find too many people that have the capacity to apply to this unique strategy, which I'm about to begin, which I'm about to talk about. And a lot of times, tax people, they're not even explain it in a correct way to apply these strategies. So anyway, I'll do the best I can. Again, I'm not a tax advisor, so let me give you some better education. All right, so if you want to reduce your taxes dramatically from your real estate portfolio, whether you own one property or 50 rental properties, one way to do this is to become or marry a real estate professional.
You really want to get married here, Sue.
No, I've been there, done that. So anyway, by the way, when I say real estate professional, I'm not saying you have to be a licensed realtor. I'm not saying you have to take a real estate test. No, any real estate investor can become quote unquote real estate professional from a tax status point of view, because the IRS actually want you to be rich. If you know the rules to the real estate loophole, you can apply this strategy in a legal way, in an ethical way, in a correct way, as long as you find a good tax advisor that can help you to do this. Mm-hmm. So a real estate professional status is within a 469 section code, IRS code, subparagraph C7. It allows you, especially when you are earning a very high income, W-2 income, for example, very, very high. I mean, really, if you earn 6-figure income, and at the same time, you have a lot of real estate holdings in your portfolio. So it allow you to deduct unlimited passive loss deductions. Normally, you could only deduct passive losses from your passive income activities, right? But in this case, all your potential real estate passive losses can offset against not only against your passive income, but against your ordinary income. Now that is a game changer. Okay.
Huge.
Huge, of course. So with that in mind, let's go over the rule a little bit. Okay, again, this is only going to be a 15-minute presentation. I can't spend 5 to 10 hours to discuss this. That'll be very not wise. Okay, step to qualify as a quote unquote real estate professional. Step 1, ideal world, you should be married filing jointly. If you're one spouse, if you're a single individual, most of the time, if you're not married, if you're a single tax filer, you're not going to qualify for this rule. So ideally, if you're married filing jointly, only one of the spouse can qualify to become real estate professional, and you get unlimited tax write-off against ordinary income or the high earning working spouse. So far so good. So the reason why is the step 2 is you must pass the time and activity test. And that test, I know the number, the writings are quite small, is you must perform rental activity on an annual basis for the qualifying spouse to the tune of 750 hours per year in real property trade, okay? Or 50% of your total work time. So 750 hours annually equal 15 hours per week, all right? Let me do the calculation for you. However, it's not like 15 hours per week. All you gotta do is work part-time to qualify as a real estate professional. No, you cannot have any corresponding job that can take away from the 50% of the total work time. So I don't want to sound too technical because I'm not a tax advisor. I don't want to bore you to death, but the non-working spouse, ideally, or maybe a part-time working spouse, he or she can become a real estate professional as long as you meet these rules, 750 hours per year in materially participating hours. What I'm trying to say is, from a practical point of view, let's say the working spouse, but by the way, a person who is single, regardless of how much money you make, you cannot become a real estate professional because you already have a full-time job. If you have already a full-time job, you cannot do the 750 hours because you have to meet the second rule, the 50% of total work time. Okay, I don't know how to explain it. You cannot do it. Married filing jointly, the non-working spouse or the part-time spouse have a regular part-time hobby job, 15 hours per week, 20 hours per week. That individual can do the real estate professional status and do the 750 hours per year, 15 hours per week in material participating the properties, and as long as that person utilize good record keeping, right, documentation, what have you. Now, one more thing I need to say is that let's say you have 10 properties, example. If all 10 of your properties are managed by professional property managers, you do not qualify as a real estate professional to get unlimited tax write-off because you are not materially participating in activity as a real estate professional. You are allowing a third-party professional property managers to manage your properties. So some of you are asking, some people are asking, what if I attend seminars like the one we're doing? What if I travel to visit my properties? What if I do research on the internet about rental properties? Do those hours qualify as a qualifying 750 hours? And the answer is no. Those are not quote unquote materially participating hours per the 750 hour rule. Does it make sense so far, Maureen?
It does, yeah. So this is a great strategy, I think, for if you've got a married couple, one high income earner, the other, I call the CEO of the household, doesn't have a W-2 or a 1099 job. And the IRS would buy that, right? That's more plausible that somebody that's not dedicated to a 50-hour, 40-hour work week elsewhere could actually participate in the actual management of their properties. So, so what you're looking for is, and it's not like you have to, you as I guess, quote unquote, non-working spouse, you would have to prove upon request. It's not like you every year have to submit your 750 hours, right? But if there was an audit and the IRS decided to look into your business practice, you would want to have good record keeping and documentation, an Excel spreadsheet of all the activities that you do, and the hours that you spend in your business, managing your business. Now, I can think of one investor, trying to remember how many properties he has. I don't remember exactly. It's in the 20-ish range. And he quit his full-time job, and this is what he does now. So he does qualify, right? He couldn't keep his full-time job and manage his properties. One, I think that would be a very busy life, but he was able, the income that he was earning from his rental properties afforded him the opportunity to make his job optional, which he decided to leave. And then now he's managing his portfolio of properties and all the activities that go into that.
Exactly. So from a practical perspective, on a personal basis, I would probably not going to self-manage all my properties. I would not do that because I like to focus my energy on traveling and other stuff. I prefer, for the most part, I could change my mind later to have third-party professional management do other work, because you know how it is, even to self-manage one property, you know how much stress that can come out of it. Not only the time you need to spend to evict the tenant or fix the house or do whatever, right? So
Seewing, my team manages 2,100 plus doors. Like I know, I hear the stories. I understand what happens there. I would not want to self-manage either.
But having said that, some people, not too many, they're still willing to manage their own property, regardless of the location of the property. Could be spread out all over the US. Yeah. Some people still will do that, and in order to qualify for the real estate professional status. Yep. Okay, let me put it in a very practical way. If the working spouse is in a high income tax bracket that are in the like 25 to 31 federal tax bracket or even higher, that working spouse makes 200,000 per year or even higher, 300,000, 400,000, right? The higher threshold of income you make on your W-2 income for the working spouse, you're subject to the federal tax table, 25% federal tax, 31% the next layer, and 35% the next layer. In addition, if you live in California, you're being taxed up the yin yang with the stick tax up to 9.3% on top of the federal tax bracket, right? So that's why so many people leave in California to take up residence in a non-state income tax state such as Texas and Arizona and Nevada and Florida, right? So that's why you see the epic migration going on. People from California going to Texas and Florida and Arizona because there's no state income tax in those areas.
It's like the retirees are leaving. Well, the people that are about to retire are like, we need to save more money, so that we're bailing out of California. And then you've got the young people that are like, I want the California living. So there's always like this going on in California.
Exactly. Yep, that's how it is. Anyway, so the ideal world would be the working spouse with a very high income, 200 grand or higher, and then in order to substantially reduce the taxes associated with a high income spouse, you need to have a lot of passive losses, right? You have to own 5, 10, 15 properties. You might have to own something higher than single family homes. You might have to own a fourplex or a commercial building or a 15-unit apartment building because of the higher cost value will give you more depreciation, passive losses to offset against the high income for the working spouse. Does that make sense?
It does. And then, you know, there's maybe people have to remember the 3 buckets of income, but the ordinary income is taxed at the highest rate, right? You've got your portfolio income and your passive income. You've got your 3 buckets of income. Most W-2 workers fall, like not most, all fall into that ordinary income bucket, which is taxed at the highest. Like you just don't have a lot of deductions, right? You can't take a lot of deductions. So how do you take deductions against your ordinary income? And this is what Seewing is talking about, through a spouse who has the ability to file as and qualify for as a real estate professional. Then you can offset that ordinary income with your passive losses through the real estate professional designation of the spouse.
And I'm about to show you a tax return example of a real estate professional, okay? As you can see. But before we go any further, on the previous video we did, we used a threshold as a passive activity loss. If you make 100 grand or less, you can deduct up to $25,000 passive losses against active income. If you earn more than 100 grand, right? If you earn more than 150,000, all your passive losses will be suspended indefinitely toward the future years, unless you become a real estate professional, unless the non-working spouse or the part-time spouse can become a real estate professional, as in this case, which we went over the rule. So let me give you a practical example. I'm using the example, as you can see here, right? 10 property portfolio. So that 10 property, including some of your portfolio in Alabama, as you can see, among other markets, right? And people, investors, they buy good cash flow properties in Midwest, in South and Southeast. Maureen, I'm sure you agree with me. You cannot cash flow. The number does not work. If anybody want to buy rental property with 25% down payment and expect cash flow, if they buy in the western portion of the U.S., if they buy in the northeast portion of the U.S., you're not going to cash flow because those prices are way too high relative to the rent you can collect in terms of the rent to value ratio, cap rates, and all those numerical metrics. Do you agree?
I 100% agree. Yes.
All right. So with that said, this 10 property portfolio, I just documented the first 3 properties because I don't want to provide too many tax return illustrations. It'll overwhelm you guys out there. At the end of the day, the 10 property portfolio, this case study determined that because of the depreciation and all the debt service write-off against the gross income, at the end of the day, that 10 property equal $133,958 in passive paper write-off. So far, so good?
Yep.
So therefore, with that in mind, since the non-working spouse apply with the rules, adhere to the rules, and they've been trained by a very good tax advisors to know these kind of rules. By the way, most CPAs out there, most tax advisors out there in the country do not understand real estate. Okay, you'd be surprised.
100%. And so if you are a real estate investor, your CPA should also invest in real estate too. If they don't, find one that does.
Absolutely. So this $133,958, if this individual is not a professional, IRS tax status, you can only if the spouse makes $150,000 or more. In this example, the working spouse makes $200,000. So ideal world to use the real estate professional status in this case. So that $133,000 of passive losses can offset against not only passive income, but ordinary income, which is the working spouse wages. So 200 grand minus 133,000 equals $66,000 in adjusted gross income AGI, right? Then on top of that, because this couple owns a primary home, they're able to get mortgage interest reductions from the primary home to the tune of 26,000 in this, uh, generic example. So the 66 grand of AGI, adjusted gross income, is further reduced by the itemized deduction Schedule A from the primary home mortgage interest deduction, right? Equal 66 minus 26 equal $40,000 of taxable income. So I took the liberty of yesterday, actually, as a matter of fact, when I'm producing this presentation, I looked at the tax table, married filing jointly, somebody are making $40,000 of taxable income. The total tax liability for this year is $4,604. Okay, it's not zero. Okay, it's not zero taxes. Okay, you still have to pay something. How about them apples?
That is pretty darn, I mean, I love this. This is the first time that I'm seeing that, the way that you presented that. That's powerful, Seewing, just, being able to look at those, those different schedules and how it really affects an investor's money out of pocket when it comes to taxes. And I was sitting here asking the question, and I don't know, because I'm not in the crypto. I think if you just have losses in the stock market, you just have losses. Is there any way to offset losses from your losses in crypto or your losses in the market or the bond market or whatever? Can you offset those losses on?
No, good question. As a matter of fact, again, I'm not a tax advisor. Based on my knowledge, any kind of capital losses you can obtain from crypto or stocks and bonds and mutual funds, you can only deduct $3,000 of losses in any given tax year. Any excess will be suspended in the future. $3,000 mass
compared to 133,000 that you
exactly.
So the three things that I've learned and I know, and it's ingrained in my mind with Seewing's I.D.E.A.L real estate investing is, there's three things you need to do to create wealth, and that is buy assets that appreciate, that cash flow, and that reduce your tax liability. And in our videos, we've shown all three, but it's not just us. It's hundreds of years of people owning real estate or investors owning real estate, the benefits that they get. They just had the inside scoop. Seewing and I, we wanted to find out what they knew that we didn't know so that we could be on the inside scoop too. And now here we are on this side of the camera wanting to share it and teach it because we know the value. Seewing uses the term value add, like we want to be a value add to your life at different critical moments in different economic cycles. And so here's the opportunity, where Seewing spent this time last night preparing those tax schedules to be able to elucidate and visually understand what the reduction in our tax bills are just through those examples. And so that's probably something you'll have to rewind and watch again and pay attention to and listen to. But what he speaks is the truth. And, and what we're trying to do here is really just get the message to you. If you are thinking about investing in real estate and you're hesitant or paralyzed because of all the uncertainty, minus those individuals that might be in industries that they feel like they might get laid off, things like that. I get that there's legitimate reasons. And so we're not trying to push everybody into, hey, you should invest in real estate. But if you have capital and you're looking for a solution and you're looking for data, fact versus fiction on how to and where to place your capital now, how much to divest into hard assets during an inflationary time, even if the cost of borrowing is going up, as long as all of the debt service is covered, it still makes sense.
Wow, you have a good way of presenting, Maureen. You're very articulate and you are very practical in your presentation, very understandable, very conceptual, very high level. So people out there, they need to value your time because you're awesome. You just bring the message in a real world status and very inspiring.
You
Yeah.
said kiss. I had to keep it civil, stupid. So that works for me. So thank you, Seewing.
Exactly. From over the years, I've used real estate tax professional status. By the way, so I just presented something that come from the horse's mouth. So anyway, I'm not gonna
Beautiful.
do it. I'm not gonna go over my personal situation. I'm very, very.
Oh, do tell. I want to see.
I'm not gonna say any more, but yes, I use it very successfully from time to time over the years. I may use it again because I know the rules and I've been through it. Uh, um, it has helped me over the years also using real estate tax professional status. All right, so that's all we have to say about this. Hopefully you got a lot of value out of this unique tax strategies. So Maureen and I, and we do our best to find the best value add presentation, and hopefully you guys got a lot out of this. Thank you so much. This is Seewing Yi from the University Network and Maureen McCann from Spartan Invest. And goodbye.
We'll see you on the other side.